Hi, everyone. I'm Rick Bensignor, and this is In the Know Trader. Look, we've been on hiatus since our premiere episode last month, but with some vacation I took, and then Christmas falling out on a Tuesday, and then New Year's falling out on a Tuesday, we've been off for several weeks. So we're back here with our first show in January. Today's show, we're going to start off with a review of some of the key markets. Lots has been going on. Obviously, there's been tremendous volatility in the markets. So I'm going to want to take a look at and show you what we're seeing across several key markets. And then we'll also have a very special guest on to discuss what's going on in the energy markets, especially the price of oil and its total collapse since the fall. Before we do that, though, given that this is only our second show and it's been a month since our first show, let me just quickly review for those of you who are listening for the first time a little bit about In the Know Trader, how it came about, and what we're aiming to do here in these webcasts each week. So look, myself, I've got an institutional background. I spent 12 years trading commodities in a variety of New York Commodity Exchange pits, mostly stock index futures over a 12-year career, but I also spent some time trading COMEX gold and silver. And I actually finished the last 2 years of my trading career on the floor in the cocoa pit. From there, I went on to the Morgan Stanley Institutional Commodities Desk. And in fact, that's when I first met today's guest, who we'll get to in a few minutes. After a few years of doing that, Bloomberg actually came after me, and I was hired to be the head of everything for commodities, futures, and technical analysis at Bloomberg. In fact, besides building all those applications, I'm actually the guy who designed their entire charting system. And after a few years there, just by chance, I actually went back to Morgan Stanley, but this time on the equity research side. And within 2 years, I was already made chief market strategist at Morgan Stanley. I did that for multiple years before the head of prop trading came into my office one day and said, you know what, forget research. We've been following your stuff for years. Come on the buy side of the firm, help us trade our large portfolio. And this, of course, was back in the days that proprietary trading still existed. Did that for several years. And then left and ultimately ended up at Wells Fargo Securities as head of cross-asset trading strategy. So as you can see, I've got over a 20-year career on the street, on the institutional side of the business. But several years ago, after I'd left Wells Fargo and started becoming a consultant to the street, I also realized the necessity to bring the individual investor institutional quality type of research and access to the type models that institutions use, which the public generally doesn't have access to. So I thought it was really important to kind of make that transition. And also, besides having a consulting business to institutions, I also wanted to help the regular day investor. And that was really the start of In the Know Trader and how it was born. So besides doing In the Know Trader, as I mentioned, I consult to some of the most continuously successful mutual and hedge fund managers there are. They hire me to help them know when to hedge their long exposure, how, when, and where to trade around core holdings, and when to reduce or actually fully exit investments. Also an active Wall Street financial products corporate training. This past summer, 4 different major Wall Street firms hired me to teach their new incoming analysts about a variety of different financial products and markets. One of those firms, I won't mention which one, but it is a top 3 firm globally, hired me to teach a 10-day, 8 hours per day gig to every one of their new college graduates who had joined the firm, and it was to teach them everything across the capital market structure, both products and then also how to actually use them. So that's another business I have. And then lastly, I'm also an approved performance coach for financial advisors, where I mostly help them increase productivity and client retention levels by teaching them how to incorporate behavioral finance theory into their ongoing client conversations. So that's kind of a little bit about me, just in case you don't know who I am, and also what we're trying to accomplish here. Most weeks, we're going to break our half-hour show down into 2 to 3 segments. We'll typically start off looking at the major markets, which would generally include the S&P, the Dow, perhaps the bond market, the oil market, maybe gold, and the U.S. dollar, and just give you a good background on what we're seeing develop and what's going on there. We will try most weeks to have a guest who can enlighten you and give you information and perspective that you wouldn't typically get just from tuning into CNBC or Bloomberg or reading the Wall Street Journal. These are true experts, people who I know over the years, and I'm actually on the street, dare I say, over 35 years, and I have a vast network of people. So I want to tap into them, again, to be able to bring the individual investor some insights that they can't typically get about what's going on in some of the markets. And then perhaps, depending upon if we still have time at that point, what we'll do is spend a few minutes each week also doing a little bit of teaching, a little way of understanding charts or perspective on the market a little differently than you would find in the textbooks. I've always been a fan that textbooks give you the basic knowledge in a perfect world if everything worked exactly the way it should. But as we all know from just real life as well as behavioral finance, people often do not make rational decisions, do not do things as expected. And therefore, even looking at charts and looking at whether it's a moving average crossover or anything that you would pull out of a textbook on technical analysis, there are, I'd say, more often than not, the textbook way of using the particular indicator is not the best way to necessarily use it. So we'll try to also do a little educational component. So you can see we have a pretty jam-packed 30 minutes each week, and I'll do my best to educate you and give you new perspectives on things that my career has exposed me to and given me insights into. So I want to take a look at a few charts now to start things off. Let me go to here. I've got some of these. Oops, I'm in the wrong page. Here we go. This should bring it up. And let me start. Let's start off with the S&P. It's kind of what most people, especially on the institutional side of the business, are going to be looking at. So you can see obviously the major decline from the October high. The October high, which is all-time highs, is smack in the middle of the screen. Hopefully you can, I think you should be able to see my pointer here. All right, so that's all-time highs. And you can see the kind of 3 different trend lines that have developed since that high as the market stabilized and created different peaks to measure from. Most importantly here is that we had talked about that if 2635 gave way, you would see, as we said and were quoted in the press, a falling off the cliff. And that's exactly what we saw in mid-December as we had that, huge move down, partially fueled by, I would say, the break of 2635 just from a technical perspective, partially fueled by the interest rate hike that the Fed put in. Nonetheless, the market took a dive and actually stopped. We're using, even though you see here a measurement in Fibonacci terms at 1.382, we actually use more something called a third trend factor level, which is this dotted line that came in at 2371. And that was the downside target once it had broken beneath this level here of 2511. Since then, it has basically caught the bottom. We had a single close beneath it. We've come back, and even today, in real time, as we're recording this morning for release later in the day, the S&P is up about 10, about halfway what it was up earlier on the open when it was about 20 higher, and the Dow had gone 250 higher. And we know that the closer we get towards 2600 and above 2600 is where we're going to have this wall of resistance. You've got the 50-day moving average here at 2639. That's certainly going to be a place people are going to look at. We only had one close above that back in December. You've got a prior trend line here that comes in north of 2650. And there's just a multitude of things, including this red line here, this horizontal line that we had broken down from. That's closer to the 26. In fact, you'll see it is 2635. So that's where we've broken down from. And we know that going forward, the market's going to have trouble north of 2600. I think fair to say anywhere from 2600 to 2700, maybe even 2750 should be a huge wall of resistance and where the market's going to have trouble getting through. So we think this is a bounce in what has generally been, I do not label this as a bear market. It has not spent enough time to really be a bear market in classic terms. I try to avoid textbook terms of correction at 10% and bear market at 20%, and really just look at what's the market telling me, where are investors thinking, what's the psychology behind them, and that's what we try to do and figure out. Now, you're going to see a whole bunch of models on this chart too that you're probably not familiar with. Again, this thing called this trend factor level, which this was the second one down, this is the third one down, and tucked in here was actually the first one down. These are increments of 5.56% in the market. A dear friend of mine, Tom DeMark, who I've known for 20 years, you might see him occasionally on CNBC and Bloomberg. He is a model designer, and 20 plus years ago, I came across his models and have incorporated them significantly into the work I do. I find them extremely helpful. And as we go through our webcast each week, I will try to enlighten you on some of the things these models show. And again, these are not generally available to the public, and if they are, they're fairly expensive models. I use them because they're integral to my analysis and the work I do for institutions. But even for my own weekly newsletter for individual investors, which is also called In the Know Trader, we use these models. So again, this is my way of kind of bringing to the individual investor a way of looking at markets the way institutions do. I want to flip to taking a look at the Dow Jones. Here's kind of a broad picture, and you can see that where this broke down from, and we're basically come right back now to the prior trend line and the bottom of the channel. And it does mean it has to stop here, but we know anywhere north of about 23,500 in the Dow, you're going to start facing some of the more significant resistance. So what I've written clients is that the bottom that we saw about a week and a half ago should stay at the bottom for a while, given the fact that last Friday, Chairman Powell gave the market the vitamin boost it needed to at least stop selling for the time being. Now, there's other economic and political events at hand that the markets still need to deal with, but at least for now, we think this is a good low. And we may possibly test it later in the year, but I think for now that should stay at the low, barring an exogenous event. And what we're going to do is spend time back and forth, very choppily in between, probably in Dow terms. I would think the low should go no lower than the recent low, and the high probably no better than here at about where it's at 25.3 or so in the Dow. That's kind of best case scenario I see right now. Let's also take a look at bonds. And here's the yield chart. This is the TNX. Again, TNX is not a traded security. It's simply an index that tracks the 10-year yield for the benchmark instrument for the U.S. And what we've noticed and had called for is that these two gaps would likely be filled, which they were last week, and we've bounced since then. And now you see the 10-year rate is kind of stalling very close to its downtrend line from the highs we made back in November at 3.25%, or in TNX terms, that would be 32.50. But that equivalates to 3.25% for the actual 10-year. There's another chart I want to show you, which I had talked about on Bloomberg TV the other day, and it's this one. And this is just a front month continuous futures chart of the 10-year futures. And what I've written and told clients is that for 2019, I suspect that bonds will really not trade, 10-year Treasury futures will not really trade much above the 125 level, which is kind of the widest peak. In other words, where we had the most volume in the last 2 years. So that should kind of cap any price advance. And that's equivalent to about 2.4% in yield terms. And then on the pullback here from the recent rally we've seen in bonds, I would suspect anywhere from just north of 125 to 120 to just north of 119 or so. These two volume peaks here should mostly contain the downside. So that we'll actually spend the bulk of the year trading in between this area that virtually saw no volume traded over the last 2 years relative to where all other volume traded. So that's my call for this year. 10-year yields mostly trade between 3% and 2.4% for the bulk of the year. I want to show you one or two more charts. Let's take a look at the US dollar index before we get to our special guest. There was a clear 5-wave pattern down starting at the beginning of 2017. It bottomed into June of 2018. Along with that, you see this number 13 here. This comes from a Tom DeMark model that is called sequential, looking for exhaustion of trend, in this case, exhaustion of downtrend. We did get clients long right on the lows of the year in the dollar, and we rode them up right into here, and then we turned flat. Recently, about 6 weeks ago, we told clients that if they're still long the dollar, this zone here in yellow, which is in roughly the 97.25 to 98.25 range, is where you wanted to exit dollar longs that you still might have had. We've pulled back. Notice that right now we are actually on the 200-week moving average. There is support here from the cloud model, Ichimoku, for those of you who know that, and at some point we'll do an educational seminar on that. There's some support here too. If the dollar can get further weakness beyond here, then I think the upper 93s becomes the target. It's this level here, which is, again, a Tom DeMark model. It's called propulsion, and the trend line off of the lows. So we're at important support here for the dollar. If it breaks, look for it to fall beneath 94. And that's my call on the dollar. And then lastly, I want to go quickly take a look at oil. And I think this is where I've got the chart. Yep. So here's a daily chart of oil. I'll explain in a second, especially as we talk to our guests, that I think the high here at 76 was not just a cyclical high, but actually the high, the secular high that you're going to see for years to come and possibly ever. I really think oil is done to the upside, and it'll be very interesting to hear what our guest has to say about that. We've sold off literally precisely 62% of the up move from $26 oil back in 2016 to the peak here at 76. We've bounced. You'll see there should be some resistance starting probably near 51 or so. Best case scenario, I think oil gets to the upper 50s, but it is my call that we will not see the 70s again for years, if ever. And that leads me into introducing our very special guest. His name is John Curran. He is a former hedge fund portfolio manager and was at Caxton Capital for many years. This was the very famous hedge fund run by Bruce Kovner. He was also chief investment officer of Tigris Financial, the family office of noted resource investor Thomas Kaplan. John has focused on the commodity space during his career, and in fact, I first met him over 20 years ago when he was a client of ours at Morgan Stanley, and I was on the institutional commodity sales desk, and he was at Caxton. I've asked John to join us today because I want you to have access to his thoughts, and he is a very successful, forward-thinking type individual who has a very solid grasp on the energy space and most particularly some significant changes going on there. So first off, John, thanks for joining us today.
Thank you for the introduction and for the invitation.
It's so nice to have you. As I said, you and I know each other over 20 years. I've always respected the work you've done. And look, we've seen oil plunge from 76 to the recent low of $42. It's now gotten a decent rally over the last few weeks, back up to 50. I've said that top is in oil for years to come, and possibly we'll never see $76 again. And this is a business I've been around a long time, so I don't typically like to use the words ever, but I have a hunch here that oil is just not going back, and that is going to stay down for a long time coming. Let me get your thoughts on what just happened in the oil market. How do we get from 76 to 42 in just a few months, John?
Well, I think it's a combination of the secular and the cyclical. Important secular shifts, which you and I have discussed prior, is that technology is allowing the oil sector to optimize every facet of its production and demand processes. And that is a very long-term trend that's going to push prices lower in a general sense. Now, the cyclical was obviously we had the bear market of 14, 15 into 16, and had the rebound that you just talked about up to 76. And my personality is one that likes to debate, and unfortunately I can't debate you on the point that 76 could be a secular or all-time high because of the two processes, both the secular and the cyclical that I'm focused on.
While you were talking, I put up a chart, the actual total trading history of WTI oil futures for our viewers to see, and what many kind of missed and didn't know at the time, but $76 was also exactly where the downtrend line from all-time highs came in.
Interesting.
So, yeah, I mean, there's a real reason to think that could be a level that's just not revisited if there's this bigger bearish transitional story that's going on. So let me ask you, what do you think are the long-term prospects for oil? I'll ask you two sides to this. Do you think 76 will come back into play, let's say, even in the next, several years? And what about, let's think about the downside. The 2016 low was 26. We're kind of halfway in between at $50, right? It's $25 either way. What's your guess of where's the next $25 move in oil, up or down?
The next 25 is a tough call. I would say we're fairly priced right now. I think if you were to say 25, I would have to say that's lower. To keep this in perspective, let's look at the bear market of 14, 15 into 16. That was begun with OPEC abandoning its quota structure. So that gives you an idea where the market is without the support of OPEC. Now you just had a recent OPEC meeting, which was contentious, but they eventually came to some agreements, and it seems like that agreement is still in the process of being formulated, ironically. But to only get to 75 when we were at 110 kind of shows you what the strength of OPEC has right now. I think the market is clearly communicating that the strength of OPEC as a monopoly, or its strength of a cohesive unit is clearly falling apart.
So you're essentially saying the lack of strength, that they've
That's
lost
correct.
the power, the pricing power they previously had.
Correct. And that's a result of multiple facets, but also the advent of the more accelerated use of alternative energy sources as well.
So when you talk about alternatives, what space in alternatives do you think is the greatest factor going forward that's going to affect the demand for oil? What would cut the demand for oil?
I personally think it's going to be solar because of the cost structure. You build the infrastructure, but then the constant cost of the energy source is zero. It's ubiquitous. We probably have some problems as far as storing the energy, but those problems are being solved day by day. Technology, again, stepping up and will eventually completely solve those issues. I see solar right now as approximately 2% of global energy usage, but that's doubling every 18 months. So if you extrapolate that forward just a handful of years, you can see a huge chunk of oil demand being replaced by solar, and that clearly would be very bearish for the oil markets.
So, if that's the case, what are the long-term prospects for the likes of Exxon, Chevron, Royal Dutchess out there? Is our audience here are individual investors? Longer term, are these names that they should be invested in?
Well, I think it's a case by case study. We all remember companies like Wang that did not adapt, and some of the photography companies that, when the technology came and it was right in front of them, and they did not realize the importance of it, and they did not adapt. While other firms recognize it and were a little bit more nimble, they did adapt. Now we're going to have to watch how integrated, how stubborn they are with the carbon-based history that they have, and see if they want to try to force that upon the consumer, or are we going to see some companies that recognize this and plan accordingly and adapt to the new world order?
Interesting. So our final question today, then, John, would be: if you're an investor, how would you invest in the energy space now going forward, given your thoughts that alternatives are going to become more and more prominent and prevalent as time goes on? Would you simply buy solar type and alternative type names, or would you pair them versus, older, stodgier energy type names?
Right. Of course, I prefer, and it's a little bit more of a thoughtful process, but the long short. So the pairing of the new energies with the companies that seem to be not adapting. There will be, at the end of this carbon cycle, there will be literally, dare I say, trillions of dollars of stranded assets that will be marked down close to zero, whether they're refineries or gas stations or production platforms. There's a lot of short opportunities there. And then as the timing for the alternative space, whenever the market sells off, I think there's going to be opportunity to purchase what will be the premier energy companies of the future.
And do those companies exist already?
I think the critical mass has to have been built already. So for the most part, I think for the hardware of the solar space, I think a lot of them exist already. But there will be new niches, as we see in any technological cycle, that smaller companies will find. And I think we have to keep our ears and eyes open for those new little niches that will probably pay handsomely for the right timing.
John, thank you so much for these insights. This has been wonderful having you on, and I really appreciate your time. I know this is a busy personal week for you, so I really appreciate that you took time to do this. That'll wrap up this week's show. I'm Rick Bensignor, and now you're an In the Know trader.